I'm going to do several examples where I walk you through lease accounting from the lessee's perspective according to IFRS 16. So this is going to be the first video, and I'm going to cover the situation where the expected residual value is higher than the guaranteed residual value. So we've got a guaranteed residual value. The lessee has guaranteed the lessor that this asset will be worth at least $20,000 at the end of the lease term. And now the lessee is expecting that the actual residual value will be $25,000. Okay, could turn out to be more, could turn out to be less, but at the beginning of the lease, they're expecting it to be $25,000, which is higher than the guaranteed residual value. That's going to be important because when we calculate our lease liability, we are assuming here that the expected residual value is going to be higher than what you guaranteed. So you're not going to, the lessee's not going to have to make any kind of final payment to the lessor for any kind of shortfall. If they guaranteed it was going to be worth $20,000 and they thought it was going to be worth $3,000, then you'd be like, oh, we're going to have to make them whole and pay the lessor $17,000 at the end of the lease. They are not expecting that here because they're expecting the residual value to be higher than the guaranteed residual value. Okay, so in short, the residual value is not going to affect the calculation of the lease liability. So the lease begins January 1st, 2022. It's a 3-year lease. Now, we know the lessor's implicit interest rate. We're assuming that that is known to the lessee. Okay, remember the lessor's implicit interest rate is the rate of return the lessor expects to earn on this lease. If that was unknown to the lessee, if the lessee did not know that that was 5%, then when the lessee was doing all the discounting, which I'm going to show you using the effective interest table method in a minute, then the lessee would use their own incremental borrowing rate of 6% as the discount rate. But they know the implicit interest rate of the lessor, so we're going to use that 5% for all the discounting, so we can just cross out. We are not going to need to know the lessee's incremental borrowing rate. It's not relevant here. Okay. Now, I've already talked about the guaranteed residual value. The payments are going to be $100,000 a year, and the first payment is going to be made on day one of the lease, January 1st, 2022. So this is going to be an annuity due. So if you want to calculate the present value of the lease payments, which in this case, we don't have any bargain purchase option, so we don't have to consider, oh, there's going to be a bargain purchase as like the final lease payment. We don't have to worry about that. And I already said the expected residual value is higher than the guaranteed residual value, so we don't, the lessee isn't going to expect to have to make the lessor whole with a final payment for that. So the present value of the lease payments, which is the net investment of the lease, is simply $100,000. That's the annual lease payment times 2.85941. Okay, this is a present value of an annuity due for $1 for 3 periods at 5%. Okay, that's what this is. All right, 2.85941. So when we multiply this out, we get 285,941. So that is going to be our initial measurement of the lease liability. Okay, so we're going to initially have a lease liability of $285,941. Now, if you were to take the present value of the guaranteed residual value, okay, so it was $20,000, but you take the present value of that, $17,277. You add these two together, you would get the fair value of the asset, $303,218. But you don't have to worry about that because that's not going to affect our calculations for the lease liability or the table we're going to do or anything like that. I just thought I would mention that to you if you're curious about the fair value of the asset. So let's get to the accounting. Now, initially, so I already mentioned that our lease liability is going to be $285,941. Remember, the lease liability is just the present value of the expected lease payments. There's no bargain purchase option, so we don't have to worry about that. Okay, it's just this $100,000, 3 payments of that. Okay, so $285,941. Okay, so that's going to be credited. For those of you who are really into accounting, you know your debits and credits, so this is a credit. We're increasing the lease liability account. Okay, recognizing that. That's going to appear on the statement of financial position for the lessee at the beginning of the lease. Okay, so this is January 1st, 2022, and they're also going to record a right of use asset. Okay, now in this example, it's not always going to work out like this, but in this example, the right of use asset is equal to the lease liability. Why? Because I made it a simple example, and the right of use asset, if you remember, I had another video where I showed you how to calculate the right of use asset. You start with the initial measurement of the lease liability, which in this case is $285,941. You add lease prepayments, initial direct costs, any costs to dismantle or remove the asset, and then subtract any incentives received from the lessor. But we don't have any of that in this example because I wrote it in a simple way where we just have the lease liability, and so that's going to be equal to the right of use asset. Okay, why do we care about this? Because we are going to have to depreciate that right of use asset. Okay, the lessee is going to record depreciation expense on that over time. How are they going to do it? Take that, divide it by the lease term. Okay, divide 285,941 by 3. That will give you the annual depreciation expense because we're just going to use straight line method here. We're going to keep things simple. Now, remember, first day of the lease, they also make the first lease payment. Okay, so it was $100,000. So we're going to credit cash, reduce the cash account, and reduce the lease liability. So it's going to go from $285,941 to $185,941 because we just made a payment. The lessee makes a payment, then their liability is going to go down. Okay, now, as I already mentioned, the end of 2022, the lessee is going to have to record interest expense on the lease liability and record depreciation expense for the right of use asset. So I've made this handy table here to help you understand that. So here, this initial lease liability, it's going to be our starting point in this table. January 1st, 2022, but also on January 1st, 2022, we also do something else. There was that first lease payment that the lessee made, so that's going to reduce the lease liability. So that's why I said you go from $285,941 to $185,941. Now, this $185,941 is important because when we calculate the interest on the lease liability that occurs during 2022, we're going to multiply this by the discount rate, which was 5%, the lessor's implicit interest rate. So $185,941 times 5%, it's going to give us $9,297 of interest expense for 2022. Okay, so they're going to make a journal entry to record this, and the interest on the lease liability increases the lease liability. So that's why this lease liability goes down when the lessee makes a payment. But when interest accrues on the lease liability, then it's going to go up. So this is this plus this is equal to this. Okay. Then the next period, so when they make the first payment on January 1st, 2023, is a $100,000 payment. Now we're going to get, I got to change my color here. A little problem with my pen. There we go. So we went from $195,238 to $95,238 when there's not a $100,000 payment. But that's a lot to take in. So let's go back a little bit over the basics. So I already told you about the depreciation expense, which is not up here because this has to do with the lease liability and how the interest is accruing on it. And eventually, basically the lease liability goes to zero because it's the end of the lease and the lessee doesn't owe anything anymore. But when we're recording depreciation expense, we take that right of use asset, $285,941, divide it by the number of periods in a lease term, 3, so $95,314 of depreciation expense recognized by the lessee each period because we're using straight line here. So 2022, so that's the first year of the lease. Here's that depreciation expense, debit depreciation expense. See that? Okay, $95,314, and then you reduce the right of use asset. Okay. Now, in terms of the interest expense, okay, you would debit interest expense and credit lease liability. This is increasing the lease liability and recording interest expense. We already did that up here. You see how the lease liability went up, right, from $185,941 to $195,238. So that's all this is, if you're not familiar with journal entries or something like that. Okay. Now, if we were to look at the lessee's statement of financial position, aka their balance sheet, as of the end of the first year, so 12/31/2022, so it's been 1 year. Okay, we'd see that there's a non-current asset, right of use asset, $190,627. Where did I get that number? Well, our initial right of use asset, let's go back where we had $285,941, same as the lease liability, but we reduce it when we record that depreciation expense. Okay, so it's the difference of those two things. Okay, our initial right of use asset minus this. At the end of the first year, we've got a non-current asset of $190,627. Now, in terms of the lease liability, it's $195,238. You can see in our table right here, okay, after accounting for the interest that accrued, $195,238, but we can break it into current and a non-current portion. The current is going to occur within 1 year. Basically, they're going to have to make that lease payment the very next day, right? So that's going to be a current liability, and the rest is a non-current liability. But you add it up, it adds up to $195,238. So I'm just trying to show you what the financial statements would look like. This would be the effect on the income statement. We've got $95,314 depreciation expense, $92,097 of interest expense, okay? And if you add these together, those are total expenses related to the lease for 2022 fiscal year. And then we got our statement of financial position. Now, notice something here. Just want to point something out. The interest expense, and I mentioned this in other videos, but one effect of IFRS 16 for the lessee is you see the interest expense is going down. Okay, the interest expense goes down over the period of the lease. And the reason is that the interest expense is higher in the early periods of the lease because the lease liability is higher. Okay, the lease liability goes down as payments are made. So the lessee is making payments on a lease, so they're reducing their obligation. So the interest is calculated. We've got the 5% times this. Okay, so that's our initial for $92,097. Okay, and so basically, as we calculate that interest expense, and by the way, if you're curious what the next one would be, if you calculate for this 47,960 or 4762, okay, that would be this times 5%. Okay, 5% times 95,238 is going to be $4,762. Just want to make sure I didn't gloss over that. In any event, it's going down because the lease liability. So initially, we calculated it using this as the lease liability. Okay, so it's the lease liability, or excuse me, it was. Oh, I made a mistake. Initially, we calculated using this, right, 185,941, and then the next time we calculated the interest expense, we multiplied 5% by a lower number, and that's why the interest expense is going down. So the total amount of expenses that we're recognizing for the lease in the earlier periods of the lease, the expenses, total expenses, when we add up interest and depreciation, will be higher than the later periods of the lease. Okay, so it's basically a front loading of expenses for the lessee. Now, when we make our second lease payment, we're going to reduce the lease liability. I already showed you that in the table. The cash goes down and so forth. And then I showed you also the interest expense, okay, 4762. I showed you how that was calculated. I'm assuming they're calculating depreciation using straight lines. So this is the same each period. And then we're going to have it for the next year. It's going to be 95,314 again. So we recognize the same amount of depreciation expense each period. And when they make the third lease payment, again, we reduce the cash account and we reduce the lease liability. So that's all in the table, but I'm showing you the journal entries as well if you learn better that way. Now note, so there's no interest expense that is being recorded for 2024. That's because the lease liability is zero as of January 1, 2024. Let me go back to the table and I will show you. Okay. So here's January 1, 2024. Okay, that's when the final lease payment is made, but the lessee still has that leased asset until December 31st of 2024, but there's no interest because the lease liability has already been reduced to zero. The lessee made all the payments, right? So there's no, we don't have any kind of bargain purchase option here or anything like that to worry about, so we are good to go. And what happens at the end of the lease? Okay, the lessee is going to return the asset to the lessor, and the right of use asset, the lease liability, they're not going to appear on the lessee's statement of financial position anymore because the lessee will be done with that asset.